Hi, I'm Maarten Ackerman and I'm an investment strategist and part of the Citadel Asset Management team. I'm here today to talk to you about what we've experienced over the past 20 years since we started Citadel. This year we celebrate our 20th birthday here at Citadel, and like anything in life, it's always good at this point to reflect back and appreciate your journey. For us, the past 20 years have been all about helping our clients discover the true meaning of their wealth. To really understand the true meaning of your wealth, it is important to understand how markets behaved, especially over the past 20 years. And again, to understand the past 20 years, maybe it's good to put that in perspective over a longer period. So if we think about the past century, since the 1900s, we had booms, busts, deflation, inflation, hyperinflation, global wars, and yet global equities on average delivered about a 6% return per annum over and above inflation. If we think past 20 years, it's also been a very tough period. We had the Asian crisis, the Russian crisis, we had the dot-com IT bubble, we had the subprime crisis, the 9/11 terrorist attacks in the US, Lehman collapsed, and more recently the European debt crisis. And yet, equities around the world generated returns very close to the long-term average of about 6% over and above inflation. If we think about emerging markets, South Africa is one of those markets. Returns over the past 20 years were actually slightly better compared to the last century. And in South Africa, returns were more than 9% per annum generated from the equity market. The reasons behind that is obviously we've seen a massive globalization taking place. China joined the World Trade Organization. As a result of that, we've doubled the labor force in the global economy. And China, busy industrializing, there's been a lot of demand for commodities. We've seen the commodity super cycle. And as a result of that, emerging markets, including South Africa, benefited. The one thing that really stands out if we compare the last 20 years to the past century, as you can see from the chart, is the fact that fixed income assets done significantly better. If you think about bonds and cash in South Africa and globally, we've seen returns, for example, in South Africa very close to equity-like returns. For us, that is one of the reasons why the past 20 years have been one of the best over the past century. As a result of that, if you think about global investors, the past 20 years have been an exceptional period. And they've benefited not only from equity investments, but also from bond investments. And fixed income bond investments benefited from the fact that interest rates around the world declined from all-time highs to the lowest we've ever seen over the past few years. So what can investors reasonably expect thinking about the next decade? Well, if you think about the fact we had an exceptional 20 years, then we do think we need to take that into account for the next decade. We do believe that equity can still generate handsome returns over the next few years, very close to the returns we've seen over the past 20 years. That's simply because a lot of companies used the period we've been in of low interest rates to deleverage, to get the business in order, to pay back debt, and they are in a position today to pay handsome dividends, and they're still trading at a reasonable discount compared to their own history and compared to other assets available. So therefore, we do think equity can still generate handsome returns going forward. We are very concerned about fixed income assets, if you think about bonds and cash, simply because we are at a stage where the global recovery seems to continue, and as a result of that, interest rates will normalize, and any interest rate sensitive asset class, like government bonds, cash, listed property, are likely to experience headwinds going forward. So what we do think is that investors in a global diversified portfolio over the next few years are likely to see lower real returns, probably in the single digits, and where we've experienced close to 4% over the past 20 years, we're more likely to experience returns closer to 3% over the next decade. I really hope this has been insightful, and thank you very much for your time. Goodbye.